Okay, good afternoon, everybody. Welcome to the weekly Take on the Market. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Let's all right, the disclaimer. Take a moment to read this. I'm not licensed. Nobody at IBD is licensed. Don't make buy, sell, hold recommendations. Our sweet spot, our circle of competence is education research. So we'll talk about the market, a lot going on in the last couple of weeks. We'll talk about the industry groups. I looked at those. I just don't see a lot of signal in there. I'll probably spend very little time there. And then some stocks to watch. There's a lot of stocks that, a lot of things going on in the stock universe. So the AAI survey, you can see it's really, really negative. Now, there's a lot to say about this survey. I don't think that the sample size is very large, but it is what it is. It gives you an idea on kind of the mood, the sentiment at this time. And there's a lot of reasons, like intellectually, when you look around, to be bearish. So you have to think about that. The Fed's raising rates, the earnings aren't all that great, and you just go on and on. And you have to remember, if you know it, everyone else knows it, and it might already be built into the price. So sometimes the market can go up when, everything looks really, really bad, right from Bill's book. But that's why we combine the technicals, the fundamentals, because I want, confirmation. I would never just go long just because of something like this. But if you had some kind of confirmation, really good price action in a group or a stock you liked, that could be a good time to put exposure on, especially if you're really light. I've been really light this year. I can't recall ever being even, I don't know, maybe at one time with the shippers, I was pretty heavy in that group, but I didn't stay super heavy in that group. Once I kind of decided on which ones I wanted to keep, I reduced my exposure. So it's been one of those years so far where you have to kind of play it close to the vest. So if you're feeling bearish, a lot of people are, and so think about that from both standpoints. If there's a reason to be bearish, maybe it's already built into the price. Now, if the price is going down, like the action today is really bad. So we'll talk about it, but the fear is there like this banking crisis? Well, I mean, it's starting to unfold, and it's unlikely. Like, I was talking to one of my friends who's been doing this for a long time. He says, seems unlikely you would have the same crisis, if 14 years later. So it usually will manifest itself differently. So that's where I'm looking around, trying to figure out, well, if this is a crisis, how could it be different? That would be kind of the clue. The PE ratio of the S&P versus the 2-year yield. And this isn't going back that far, but they tracked pretty close. And, when the market rallied and bonds got hit, it widened. Now today, I don't know, I don't want to make too much of a single day, but you had quite a signal in the bond market today. The bonds, TLT was up 3 and change. What's that? 2 3/4% or something. So it had a really big day. And the bonds are usually, that's like a fear trade, right? If you're fearful of the system, if you're fearful of anything, they run to bonds. Like what did Paul Tudor Jones do on the day of the crash of 87? He was short stocks, and he talks about in Market Wizards how he started to think, well, what will the Fed do? And he started buying bonds, and they didn't do anything at first. And then they started to move, and then he got really aggressive. And I guess allegedly he made more money in bonds from that trade than he did from being short. So the bond market, I'm not an expert by any means on it, but it's really been kind of the straw that stirs the drink in the market lately. Really bad. There's always been a relationship, of course, between stocks and bonds, but the last 18 months or so, it's been highly correlated. Feel like we're glued to the screen for every CPI, PPI, NFP report, every acronym you can think of is just has us on our toes. So it's made it pretty difficult to put on any size, like I've talked about a lot, as far as having size, knowing where your stop is, knowing that you can take your stop. I think today I was short one of these banks, and my stop was, it got halted and jumped up, and my stop was like 7. I think my stop was 70 and I got 76 or something like that. So, now I had that built into the model on the position size. So it doesn't really bother me that much. It is what it is. I knew that was a possibility if I was going to play in that playground of shorting some of these bank stocks, and we'll pull those up later. Here's the German Bund. It's 3%, which is the highest since 2008. Look at that chart. Look at that, the speed of the move. So the speed of the move, and history says, doesn't have to happen like this, but a lot of times bear markets end with some type of crisis. So in 1998, long-term capital had to get rescued. In 2008, Bear Stearns and Lehman, and it seems like we probably could go on and on other ones, but we haven't had that crisis yet. But maybe we are having it right now. Maybe SIVB is the crisis, and I know it's just a simple bank on the West Coast, but it's a really large bank. I think it's one of the bigger banks in the S&P 500. It is a member of the S&P 500. It literally went to zero in a handful of days. And it's the contagion. It's dragging other stocks down precipitously. So maybe we're in the midst of a crisis. And one of my favorite follows on Twitter, he always seems to tweet. He's got a go-to tweet, and it always seems to be in these type of environments: crisis equals opportunity. And that's true. So this will set up an opportunity. It doesn't mean it's today or Monday or next or Tuesday, but it's somewhere. There'll be an opportunity based on this. All right. So what happened to the industry groups? So let's do industry groups or the indices. We haven't even done the indices yet. So I don't know how we jumped ahead to stocks to watch, but let's do the indices. I'm going to turn off my camera so you can see the indices better. So here's the NASDAQ, and you've got this squeeze going on, and it looks like on the surface that the bears are going to win. It's going to squeeze lower. If I go to the weekly, right, and 3 things happen in an environment like this. So you break, and you get another leg down in the bear market. So here's a leg, here's a leg. That's a possibility. You break, and then you rally. That would be ideal. So you get a fake out to the downside. That would be the perfect scenario. That's a possibility. I don't know how much downside you would get before that happened. I think if it undercut the lows, that would be fine. But it's a possibility. And then you get just the grind lower, and then maybe it can go higher after that. I don't know. I just don't think it's a very good environment right now. It's a pair of twos, like I've said a million times. I stole that from Carter Worth. It's not a great market. Before Thursday, it wasn't terrible either, but now I'm leaning. It's not even as good as a pair of twos. It's like 10-6 offsuit. It's not a great market. And my instinct, just because that's what I've done forever, is shoot first, ask questions later. When I see things kind of coming unhinged. My first instinct is protection mode. So get to cash, get really, really light. And then once I've done that, then I'll look around and say, okay, do I want to speculate? Because I like to speculate. That's what I do. And maybe I'll put on some shorts on things that I think are worth it. But I don't really have a lot of short exposure. I did short SIVB, I shorted MCB, shorted SBNY. I'll pull up those banks, but in FRC, but they were all very small, highly asymmetric trades. If I was right, like SIVB, I did pretty good. If I was wrong, like FRC, which was the one I got stopped on, 6 points higher than I expected. The position size is very small, and so I lost a little bit more number-wise than I expected, but I had that built into the model. So I am short these and very, very small, with the idea that, the old cockroach theory, there's usually never one cockroach. And expecting, for them to go down a lot. And so the smaller position size will become worthwhile profit because of the size of the move. But if I'm wrong, then it doesn't, the smaller position size helps. So the S&P doesn't look great either. And IWM, which has about 15% exposure to financials, according to Justin Nielsen, who gave me that stat today, down 8% for the week. Doesn't look good either. If you'll see on my chart, a kind of broader thought process. This pink line is the 150 EMA. So this is the 150-week EMA. And I was talking to a friend of mine who's traded forever, and he was saying, if you just bought the indexes when they were below the 150 EMA and had patience, you'd have made a bloody fortune in the last 25 years. And you can see what a great buy it was there, what a great buy it was here, great buy down here. If I go back to, let's say, 2012, you can see now, if it's really bad, if we're in like the old once in a lifetime bear markets, you're going to get run over. So if it's living below that line, you don't want to be doing that, but you want to be buying it when it gets close, right? When it gets close to that line, 1 week down, 1 week down, 2 or 3 weeks down, half a week down. You see that? So if right now we're kind of living below this line, you can go back and look at historically, it works really, really well, as long as it's just a week or two below it. So maybe what you do, rather than being a hero, is you wait for it to go back above it. And a lot of times you might get a follow through day signal to do that, but if not, then you have this signal. But this is a number of weeks below it. Try to rally so we've got all these weeks below it, and it just doesn't. It looks like a very heavy, really bad bear market. So I've got all these signals. I have this signal that tells me this is a really bad bear market, but then I have, the sentiment, which tells me everybody sees that it's a bad bear market, therefore it might already be over. And so it's just a very tough environment right now. And, so you have to play accordingly, I think. I haven't been putting on very rarely much size, and then the bond market has been really, really bad. Now, it's not any fun that I've got to be kind of tied to the bond market, watching bonds and all of that. I would rather kind of just forget about what the Fed's doing, but it is what it is. It's part of what the lexicon now is. So you have to kind of keep one eye on it. And this was a really big day, 3.5% on the TLT, 0 TNX, which is the 10-year note, right? Look at that. So if that was a stock, right, is building this base above it, boom, gaps down below the 50-day. Is it zero FVX is the 5-year. Not quite as bad, but below that. So maybe today was a signal that that either the market thinks the Fed is done, or maybe there's something wrong, and therefore the Fed has to be done, whether they like it or not. That's the old adage, that all the bear markets end in some type of crisis. And I don't know if SIVB qualifies as a crisis, but it sure would have felt like one if you were in it, right? If you're in some of these bank stocks. So I subscribe to the theory. I don't know if I've said this already. Shoot first, ask questions later, and I'm in that mode right now. I don't have any. I think, do I have any longs? No. I think I got really light. I had a couple of longs, and just decided this week that it just didn't like the tape action. I'm not in any hurry to try to be here on the short side either. I do have a couple of shorts, but they're very small positions. And then I have some bonds because I'm trying to capture, what seems like in nominally like a really good yield, because we've been in this zero interest rate environment forever, and now you can get 5%, in 6-9 month T-bills. So I do own a lot of that, so I have to wait and see. As far as stocks to watch, it's just SIVB, and it's gaps down on earnings. And then this morning, it was trading in the pre-market, but then it just got halted, and then that's that. So it's pretty frightening when it can. Now look, this stock is way broken, way broken, obviously. But when it goes from, and then nominally it doesn't really matter, but when it goes from 270 to 30 or whatever in 2 sessions, that's pretty frightening. And it is in the S&P 500, or was. And so the carnage, the spillover is, SBNY, which I've been short, Silvergate, which went to 0, basically, right? You can't even see, but that happened a few days ago. And MCB is another one that's rolling over. And I think the ETF, for the regional bank ETF, is down 16% for the week. So that's COVID-like. Here it's down 14%. Here it's down 18%. So, let's not sugarcoat it. That's an awful week. So I'll step aside. I'll let the dust settle. Again, crisis equals opportunity. So I don't want to get all bearish and all negged out about it. But once the dust settles, there will be a chance. I don't think it's going to be in bank stocks. I'm not in a hurry to go there. But if you're getting hurt, if you're a fund manager or a hedge fund manager or whatever, and you're taking on water in XYZ and ABC and all these other stocks are hurting you, your instinct is you almost have to do it. You just get out of everything. Sell what you can, not what you want. So the best stuff will go down as well, because they need liquidity. If you can't get out of these names, you need liquidity, you run and get out of the other stuff. And that's why something that could be totally uncorrelated to banking can go down 5% on the week or something like that, because of just the lack of liquidity. And, and there's a million speculators like myself that, I'm not in any hurry to make a bid. So there's no bids. So it just kind of feeds on itself until it doesn't. And I'll wait till that ends. Schwab bothers me a little bit because, I don't know why Schwab would be affected by what SIVB is doing. And some of the headlines were a little sketchy, like, the cash concerns. I don't have an account at Schwab, but I will pretty soon, because TD Ameritrade will convert to Schwab in a couple of months for me. But, Schwab down 24%. So as that type of action, I just don't. I just think protect yourself, get lighter if you're heavy, and just survive this period. And 90% of this game, and I guess it applies almost to anything I get in life, is just live to fight another day. If you don't have an account, you won't be there for the next bull market. So you don't need to be a hero here. Live to fight another day, and you keep your capital ready for the next up leg, whether that's next week or 6 months from now. I don't know. Only time will tell. So let's look at some of the other stuff that Apple, and here's the Goldman Sachs upgrade on Apple. We could have a whole show on that, on how I feel about that. But that doesn't look very good. It doesn't look terrible, but it doesn't look good. Amazon is very, very heavy. I am short Amazon. It just can't seem to get out of its way. Here's the Amazon down ETF, building this cup with handle. So I do look at these because I think, well, that's a little low on the handle. It's not a great pattern, but if the Amazon down ETF's building a cup with handle, what does that tell you about the other way? Google, right? Not exactly acting well. Microsoft, and I guess Nvidia would be the best of these. It's holding up pretty well. And then last but not least, Tesla. It rolled over a little bit, although it is getting support on the 50-day. And today I am short Tesla. Today, it was up 52 cents with everything else melting down. Stock was unchanged basically. So I have to admit, pretty good action, but that's not a great weekly bar for that one. So not a lot to say. Now, the stocks that were acting the best for me were like TNK and TNP, and Sting was okay, not the best, but okay. Nothing wrong with the way it was acting. And TRMD, but I just kind of got pushed out of all of these just because of the overall market action. And I'll tell you, I think probably my guess is when I do that, when I make a decision to remove stocks that aren't really doing anything wrong, but something about the market bothers me, I'm usually wrong, probably 6 or 7 times out of 10 when I do that. The problem is those 3 that I'm not can be really, really bad. So it's the magnitude of those 3 times out of 10 when I'm not wrong are historically really large. And so that weighs on me when I make decisions like this. The odds are really high that I was wrong to move out of these. But if I wasn't wrong, then the magnitude of the move down in the overall market versus in these stocks that I had, it's just so large that I'm usually really glad that I did what I did. So I'll step aside and wait it out. So I wish I had a more definite answer on the overall market environment. I think anything could happen here. It feels a little heavy. The action in Schwab bothers me. The action in obviously the banks, when they go down that much that fast, that has to bother you as well. So let the dust settle is the name of the game today, I think. All right, so let's move to the quote of the week. And it's from the book, The Tao of Capital. And the author is Spitznagel, but he quotes Everett Klipp, who worked on, he's called the Babe Ruth of the CBOT, I think, or the CBOE. And he was a floor trader. And you got to love to lose money, hate to make money. Love to lose money, hate to make money. but we are human beings. We love to make money. We hate to lose money. So we must overcome that humanness about us. I really like this quote. I think I've probably used this before, but I think about this quote a lot. I live this quote, and it really, really saved me from making a bad mistake this week, because even for myself, I can get caught in that trap. I get, stock's not acting well. I don't want to cut the loss. Stock's acting good. I want to take the profit. It feels good to take the profit, right? We love to ring the cash register. I still love, to this day, love to ring the cash register. I have to fight that urge to ring the cash register, take the position off. And I'm not good at it even to this day. The way I combat that is I don't get out completely. So I might, if I have 1,000 shares, I might sell 100 shares. I might sell 200 shares. If I have 3,000 shares, I might sell 200 shares, literally something that small, just to fight that urge to ring the cash register, but it doesn't reduce my position too much. That's the way that I combat that humanness about myself. So yesterday, let me give you a real life example. Okay, so yesterday I shorted GE. Now we can go into the trade setup a whole nother time. Forget about that. You're right. It is not a. It's not a short, right? It's not. There's no setup here, right? I just, something about, I saw it gapping up on revised guidance, and I don't know. I just thought it's GE. What's innovative? It's made a big move. So I did everything wrong, and I couldn't help myself, but I shorted GE. Okay, it is what it is. I shorted it, and as soon as I shorted it, it was up 20 cents. It was up 40 cents, up 60 cents, up 80 cents. I mean, as soon as I shorted it, it never looked back. Like the whole time, it just kept going up and up and up. I also shorted SIVB, and let me change the date to yesterday. Let me see, pull it up on the intraday as well. Oh, I'm in the change state. Okay, so SIV opened down, gosh, 80 points, and I was, it wasn't really on my radar to short it, but then it was down. I have a system in TD Ameritrade where I can see stocks hitting day low and hitting day high. They're color coded. I really like that, and it just kept color coding day low, color coding day low over and over. Well, GE was color coding day high, of course, over and over. And I thought, maybe there's something really wrong here for it to be down this much. I was short Bear Stearns in the 2008 crisis in Lehman, and in way, like, it was the whole shoot them in the back theory. They were really broken, and I just had that gut instinct thinking back then that something's wrong with these, and they're going a lot lower. And that was my instinct on SIVB. Something is wrong here. It should not be going. And I just shorted like 100 shares or 100 shares, 100 shares. And it just kept going lower and lower and lower. And the whole time it was doing this, GE was going higher and higher and higher. So what did I do, right? What's the right way to do this? So if we love to make money, hate to lose money as humans, what would I do? I have to fight that urge, right? Well, I love to make money. So SIVB was going down, and I covered it because I love to make money. It was a great trade, just a handful of hundreds of shares that I pyramid into, and it made 20 some points. And GE, which was going up and up and up, did I cover that? No, because I hate to lose money. And it just kept going up and up and up. And So remember, I was shorted here. I can't remember if I shorted it right on the open, but I think my price was 90.30 or something like that. And it went all the way to 95 almost. So it just kept going up and up and up. And so SIV was just kept going down and down and down. So the right trade would have been cover the GE, take the loss. And if you hate to make money, then you don't cover SIVB. You allow it to keep going. So I saw this quote on my wall here, and it was like a light bulb went off for me. And as SIVB kept going down, and GE kept going up, and I said I did exactly what I wasn't supposed to do. I did exactly what I could not overcome my humanness. I did it exactly wrong. So at that moment, I covered the GE and took the loss. It was a good size loss. And I re-shorted SIVB. Now, out of position pretty bad. I got to short very, very small again and do that. But now it turned out to be an awesome trade because SIVB went down immensely more than GE went down. Now, GE did go down from where I covered it. I think I covered it 93 and change or 94 and change. So I did cover it higher, but percentage wise, what did SIVB go down compared to if I had kept that capital in GE? Not even close, the difference. And so I was really happy with the fact that I was able to do that because it wasn't easy. I didn't want to cover GE. I quote unquote knew I was right. I knew it would do what it did. All right. And it's very difficult to put on a trade, whether it's long or short, after you've just taken it off and it's gone against you or would have gone for you 10, 15 more points, 5, 10, 15, 20% more, or whatever the number was. I can't recall. So this is something that you'll find, like when you do your trades, think about this, your process. You've got to love to lose money, hate to make money. And if you can reverse your thinking about it, you've got a really, really, really good chance. The book is The Tao of Capital. It's he says, oh gosh, I really want to remember what he says about people that don't take quick losses on the board. They're either retired or immensely wealthy, and or they're either retire immensely wealthy, or they've been kicked out of the game, so to speak. They're no longer in the business. And in the book he says, and I don't know any of them that are retired or something like that. So I butchered the story. Read the book. It's a good book. It's not going to teach you anything on strategy or how to put a trade on or anything. It's just going to teach you how to think. Yeah. And that's most important. We all have the strategy. I think the strategy part is down pat. So, okay. Thank you guys. I really appreciate all the feedback I get. MarketSmith@investors.com, 800-424-9033. I believe I will be back next week. Have a great weekend. Take care.